Welcome everyone to our third workshop of this series, Financial Management. My name is Adil Mirab, and please note this session is being recorded and will be available on the project webpage early next week. The presentation today and the additional tools and resources are available for download on the project webpage, which will be posted on the chat box in a minute. Next slide, please. Okay, first, we would like to mention a few housekeeping, engagement, and self-care points for this session. OCASI is committed to supporting full participation and engagement by all attendees at our events, including people with disabilities. This session is facilitated in English, French simultaneous interpretation, American Sign Language, ASL, and LSQ, Quebec Sign Language, and English captioning are available. If you would like to enable the French simultaneous interpretation, you can go to your meeting control toolbar at the bottom of your Zoom screen, click on interpretation icon, and then choose French. If you would like to use the ASL or the LSQ feature, you can also go to the control toolbar at the bottom of your Zoom screen and click interpretation icon. And under watch, you can click on either ASL or LSQ. Next slide, please. Also, if you'd like to enable the closed captions, at the bottom, you'll see the show caption icon, CC. You can click on that to enable this feature. We also encourage our participants to share your thoughts and your questions on Slido. You can go to the Slido website itself and include the code here, or you can click on the link which will be posted in the chat box in a second. Or if you prefer, you can scan the QR code on the shared screen with your mobile if you prefer to access Slido through your mobile. So we'll just give 5 seconds for anyone who would like to scan the QR code. In the meantime, it's important to also mention that if you have any question about the instructions that were provided before, please let us know and we'll include them in the chat box too. Now, I would like to mention a few housekeeping. Sorry, Leah. Sorry, if we can go back to the previous. Yes, perfect. Thank you. I would like to mention a few housekeeping, engagement, and self-care points for today. Zoom fatigue is real, so do what you need to do to take care of you first. Stay present and be attentive to your body and your emotions. And finally, please fill out the evaluation form that will be shared at the end of the session to help us improve our future workshops. Second slide, please. I would like to begin by acknowledging the traditional territories of the peoples of Turtle Island. The secret land on which we are gathered today has been a site of human activity for 15,000 years. We acknowledge the land OCASI is situated on, which is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit and Mataz peoples. This territory was the subject of the Dish with One Spoon Wampum Belt Covenant, an agreement between the Haudenosaunee and the Ojibwe and allied nations to peacefully share and care for the resources around the Great Lakes. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Thank you. Second slide. Okay. Now we'll start the workshop. As I said, this is our third workshop focusing on financial management, and I would like to introduce our trainer for today's workshop, Roger Runkinson. Roger is a seasoned financial and human resources specialist with significant experience working with the nonprofit sector in various capacities. He is also the former senior manager, finance and administration at OCASI, and offers a wealth of knowledge and experience with IRCC-funded agencies.
Thank you, Adel. we can go directly to the next slide. Okay, thank you, Adele, for that really warm introduction of me, and I will just add a few sentences. I am a CPA, CGA, or Certified General Accountant, and a Certified Human Resources Leader by profession. And as Adele mentioned, I have been involved with OCASI since my time in Canada. And even though I do not physically work for the organization anymore, I have stayed uh, connected, and I do serve on a number of OCASI member agencies as board chair. I am also an immigrant, so I do have lived experience, and I do share some of the concerns that some of you on the session today would have shared. But most importantly, I am committed to making sure that immigrants and refugees who decide to choose Canada as their home do have an equal space and equal place in this beautiful country of Canada. So a little bit about me, and again, thank you, Adele, for that warm introduction. So today we're going to speak a little bit about finance. And I know, generally speaking, it's one of those topics that everybody seems to find somewhat difficult. But I'm going to try to make it as simple, and I'm going to use very layman's language for you. The intention is that if you have any questions, we will address those next week. If we do have time, I might be able to address some of them at the end of the session today. I have developed a number of resources that has been shared with the team that you will have access to. So there's no need for you to take pictures of the slide, as Adele mentioned. You do have the slides available. But what I would encourage you to do is take notes of any questions that you may have based on those slides, and I can certainly address those after or within the session that follows next week, Thursday. So by the end of today's session, I'm hoping that you could be a little more comfortable with budgeting. And let's face it, that's probably one of the biggest challenges in any agency, whether it be nonprofit, charitable. You can only spend what you have. So we're going to cover the basics of budgeting. We're going to spend some time as well talking about financial reporting, the statements that come from the nonprofit sector and as a charity. We're going to go a bit into financial oversight and controls, and this is really important from a governance point of view because it's the one area that tends to get us in trouble. It's easy to break down. And of course, when there is a lack of financial oversight and controls, it's the one area that could cause your charitable registration and status to be revoked if it gets there. But generally, tend to start with a breakdown of control and oversight. So we're going to talk a little bit about that today as well. Coming out of some of the feedback from some of the participants prior to the session today, we heard a lot from you that you wanted to go a little bit into contribution agreements and how to comply. So we're going to speak about that as well. I'm going to offer some tips on financial best practices. And of course, that last question that everybody has on their mind is how do we stay relevant? How do we sustain ourselves, and how to help us resource manage and do that differently and better? Because at the end of the day, we want to be around for years and years to come. We want to continue to serve our communities. We have started as an agency, of course, with the intention to be around in the future. So I'm going to offer some tips on that aspect as well. So we are going to go right into it. But again, as I mentioned, at the end of the session today, we do have about an hour and 15, 20 minutes. I'm hoping that you can walk away with a better understanding of these 6 core areas. Next slide, please. All right, so I did say we are going to speak initially about budgeting. So let's talk about budgeting and what it is from a very basic framework. A lot of us tend to, when we hear the word budget, we tend to speak to it or think about it from a numbers perspective. And yes, numbers are important, but it's much more than just numbers. Because from a framework perspective, it's that document or that budget that is used to help us plan our activities, our programs, and certainly our deliverables. Without that very important tool, and again, it's a very basic tool, we would be lost as to how we could implement and most certainly measure the outcomes of the funding that we just asked for. So I'll start by offering a very basic definition of what a budget is. And this is really important because as nonprofit and charitable agencies, once you're funded by the feds, the province, or local government, one of the basic requirements of any funding agreement is that an agency should have or is expected to have a budget. So a budget is a planning document used to plan for your income and expenses over the course of a set period of time. And a set period of time is important because you want to make sure when you design a budget, it's within measurable objectives and measurable periods. So most of you, your period would be, or your measuring period will be April 1st to March 31st. That's sort of in line with federal and provincial fiscal years. I know some agencies has January 1st to December 31st. And again, the fiscal year itself or the measuring period can change depending on the needs of the agency. But I'm saying that the period of the agency or the period of that measurement should be set. So going back to the definition now, it is a guide that can help you or help your nonprofit or your charitable agency plan for future. It helps to coordinate activities and set realistic targets. And setting the targets is important because when we get funding for a budget year, which may or may not coincide with our fiscal year, but it's generally always within a set period. So when you have plans and activities set, it really is important to have the quantitative information, which is what the budget reflects in terms of dollar value, to help us achieve those targets. The budget helps us or agencies to assess our current financial health. And this is important because from a revenue or grant funding versus expenses point of view, when you put all of your funding together, if you realize that you are short, as we would say, or have a deficit or surplus, then you really need to reassess budget goals. You may have to chip away at your programs. You may be forced to make alternative decisions. So when we talk about assessing financial health, at the 1st of April, when your board gets a budget for approval, a nonprofit board would likely not approve a budget with a deficit because they will ask the executive director, okay, how are you funding this deficit? So again, a very important aspect of the budgeting as well is really to assess financial health. Keep spending in check. When we report back to our board, whether it's monthly, quarterly, or how often we have a board meeting, one of the key principles of budgeting is to ensure that the realities of the agency mirrors that of the budget. So let's just say on the 1st of April, your board would have approved a budget of, let's call a number of $1 million for a year. And by, let's assume June 30th, the first quarter, you realize that you would have already spent all the dollars in a particular line item, then that should be an immediate flag for anybody who's reviewing your financial statements, certainly the executive director and certainly the board. If there is a chance that you overspend on a particular line item, the purpose of that budget is to question what has happened. Now, in answering that question, you may realize that maybe the program is much more successful than you thought. Maybe in the next rounds of negotiation, you should ask for more on that particular line item. But again, tying it back to the purposes of the budget, it really helps us to ask those tough questions about, are we spending enough? Are we spending more? If we're spending more, why? Do we need to chip away at something else? Do we need to request a reallocation? And again, that's the whole framework of having a budget, because you can't ask those questions or make different decisions without having a starting point. And the budget really is your starting point. And the last point on the slide is highlighting administrative pressure points. Now, we all get up to 15% admin dollars through your federal agreements, and then that could change depending on if you're provincially funded or municipally funded. This point isn't here because, as you know, that 15% is an automatic 15% based on program. When you're designing your budget and you realize that you do not have enough admin dollars to cover rent, cost salaries that may not be tied to program, for example, executive director, finance manager, HR director, if you have one, or even supplies, what it really tells you as an agency is, hey, I need to figure out how to trim those expenses from my 15% that's been allocated strictly to admin, or make a case to reallocate those dollars back into administration if your MOU or your contribution agreement allows for it. But again, I always recommend that when you're doing an overall budget, that we have a sub point or sub admin budget. And one of the resources that I've developed for you is a budget template, which will show exactly that. And again, the point here is to really highlight the pressure points because, as you know, your funder might fund all program dollars to 100%, but because your admin in the federal case is tied directly to program, it may not always be sufficient to cover those admin expenses. And let me just reiterate that your admin expenses generally does not disappear or does not change depending on the level of program. So for example, if you have a lease and your lease is locked in for 5 years, whether you have one program or 5, that lease cost doesn't change. So again, the pressure point would be that your program dollars may reduce. Your admin is based on your program, but your lease is not changing. So again, the intention is to highlight what those pressure points is that you cannot control. Next slide, please. So let's talk a little bit about why budgeting is important. First and foremost, and going back to the slide that I mentioned just now, it is a resource availability to achieve core program objectives. I believe most of the agencies on this call, on this meeting today, has just under $1 million. One of the things that you want to do, or one of the tools of the budget, is to help you determine if out of that $1 million, you have, let's say, $800,000 to program in, that you have enough to meet your program objectives, or determine if you have to scale back your program objectives to meet your budget. Sometimes you might have to go back and forth with your funder because cost increases and so on. You might have to go back to your funder and say, okay, you know what? I have $800,000. I can't do 5 workshops. I might have to do 4. So again, that document, which is your budget, helps you determine what program objectives, simply because one of the goals of budgeting as well is to quantify through costing the cost of each program that's being delivered by your organization. So again, that ties right back into service levels. So if you have a limited budget and cost is increasing to deliver a service, but you have an inability to get more program dollars or more admin dollars, then what's the next best solution? You unfortunately have to sometimes scale back your service levels. And that's the unfortunate part of it. We can't always control how much more dollars we get at the federal or provincial level. So most of the times, service level tends to impact. So you might have to reduce the level of clients you see, reduce the number of workshops, decrease the number of participants, and so on. But again, you can't make that decision without having the evidence base or that document or that budget, as we will call it, to make those decisions. The next one we're going to talk a little bit is about strategic and program goals and objectives. Most of our agencies has what we know as mission, vision, and values. And a lot of times when we have limited budgets, we have to choose. We might have an objective within our strat plan that has one objective, but we don't have the funding for it. So as part of your budgeting exercise, you come up to the realization that you have a finite level of income, you have a finite level of grants, you have finite level of funding sources. And when you look at your priorities, you have to decide, well, you know what? I'm going to have to prioritize these priorities. And I get it sounds funny because everything is a priority, but decisions have to often be tied back to the funding that you have. The next point is funding diversification strategies. And this is really important because when you have priorities or strategic priorities that we just spoke about, and you realize that your existing budget cannot meet some of those core priorities within your organization, the agency have to have these really tough conversations about how do I get more dollars in? So whether do I seek different grants? Do I expand my catchment area? Do I expand my geography? Those are the tough questions that has to be answered when you prepare a budget. Again, all this ties back to funding, strategic priorities, and so on. Again, the next point will be impact as a caveat for sustainability and secure funding. What I really mean here is your budget tells you where you need to advocate. And if through your budget exercise and through your programs, you realize that this source of funding, whether it's federal government or municipal, is secure, you really want to use that tool to continue to advocate for your funding levels and also increase funding levels. And the final point on this slide is inform governance conversations. And this is important because, as you know, from a governance framework, even though most of us are nonprofit or charitable organizations, unfortunately, we are not exempt from governance issues as the bigger agencies. We operate within the same framework in Ontario. So we are still governed by the HR frameworks, for example, the Employment Standards Act, and so on. We still operate in an environment where, as you know, as nonprofit and registered charities, we have to follow the framework of ONCA. And I'm not going to speak to it too much. I'll leave it as a resource for you. But again, the budget helps align governance with governance outcomes. Next slide, please. So to wrap up the conversation around budget, most people ask themselves, so when should I start doing a budget? Well, assuming your fiscal year starts April 1st of any year, let's assume April 1st to March 31st, I will always recommend that you start your budget process no later than the end of January. And that's because it really takes time to answer those questions that just went before. Do you have enough program dollars? Do you have enough admin dollars? Do you have enough staff in place? Are you going to expect more clients? So again, the process should begin at least 2 months before the start of the fiscal year and should include input from all staff across the program, definitely the board, and definitely the executive director. In most of our structure, the Board Finance and Audit Committee, as we would call it, the FAC, should really oversee the development and execution of a budget through the treasurer, led by the treasurer. And again, I'm going to go back to that time of 2 months because it really takes time to get your budget together. Even if you're a small agency, when you start putting the numbers together, you will see how quickly you tend to have a deficit rather than a surplus. And the reason why I did talk about including the board and the ED is because you want to make sure that your budget drives strategic priorities. You want to make sure that those programs are also aligned with your mission, vision, and values, and that you have had the opportunity to get feedback from every level of the organization to feed into those numbers. Because as I mentioned in slide 2, the budget is not just numbers, it's also a plan to help us achieve the goals of the agency. You will also quickly realize that that timing of 2 months is important because you might need to have a few reiterations, a few iterations of your budget, depending on how much funding you get. So if you realize that you're in a deficit, you're gonna have to go back to your staff, go back to your ED and say, you know what, well, I'm running a deficit here. I can't run these program levels. So again, it really is about engaging every level of staff to come up with a final product. Anytime you start your budgeting process less than 2 months into the fiscal year, you would really quickly see how it becomes a boiling pot because it does not give you enough time to make those changes, get it approved at your board, feed the information back, and certainly work with your fund on any changes or any additional funding that might be available to you. Next slide, please. So let's talk about what that process looks like. So it's April 2024 in a few months, by the end of Christmas, by the start of January into the middle, let's say by the end, you should start reviewing your contribution agreements and funder contracts. That assumes that you have, let's say, agreements that run over fiscal year. I know most of you have contribution agreements that ends in 2025. So let's just assume for a minute you have an existing contribution agreement. You should start reviewing those by January. And that is to make sure that there are no changes to your contribution agreements. There are no changes that impacts that fiscal year, to make sure that your contribution agreement can meet the service level agreements or the service targets that you have in mind. Because you might have, let's say for an example, you might want to deliver 10 workshops, but then when you look at your contribution agreements and your funder contracts, you look at raising salaries and benefits and everything else, you may have to cut down to 5, 6. So again, it really is important that you start reviewing those contribution agreements as the place to start. Identify operational program objectives aligned with mission, vision, and strategic plan. And again, this is important because you want to make sure that if you have to choose, you extract those objectives that really align well with your strat plan. Most of them should be aligned anyway, but I'm making this assumption based on the fact that if you have a 5-year, let's say, contribution agreement fund IRCC, by the time you get down to year 5, the pressure points driven by salary increases, increase in cost of living, and so on, would generally be felt more at the end of the agreement rather than upfront. The third point is determine the financial resources needed to achieve program objectives. What I would encourage folks to do is start with your best place, start with your wish list, start with what you would like to achieve. That's your place, that's your starting point. But then when you have a look at your budget now, and you have a look at your contract and your numbers, you realize that this is your wish list. The numbers cannot obtain that. So you have to come to some compromise. You have to now start that process where you are chipping away, where you're trying to align both of them together. Align staff on board. One of the things that you really want to do is to make sure that your board has buy-in, has knowledge of the budget, has knowledge of what the changes are going to be. You want to get buy-in from your staff as well, because they have to be committed to the changes. And that's the reason why you want to get the involvement of every level of the organization. Document decisions and assumptions. And again, this is important because I've gone through monitors with IRCC where they ask for this information. Because you may, for example, do a reallocation of a line item, and they may come back to you and ask you as a funder, on what decision did you make that request? So you also want to document. And I'm going to pin this point for probably a later slide. When it comes to auditing, this is important as well, because your auditor will generally often ask you, on what decision did you make a reallocation request? And for all of those who have gone through a financial audit, you will know that the auditors like to see paper trail, like to see things in writing, especially when it's a little bit different from a signed contribution agreement that you have already in place. So again, you want to make sure that you document, you keep a record, and so on. To make life easier for you, I would encourage that you document and customize the process for future use. If you're a brand new agency and you've never had a budget before, start documenting, create your templates, save it in a place where you can use it for next year so that the process becomes much more simple, robust, smoother in subsequent future years. As well, this is important for comparability, right? Because you want to compare the process and to see if you can make changes to it, if you can make it better for you and the board, if the information that's coming out of your process should be tweaked and amended for people who are not financially savvy. So you really want to document as much as you can. Next slide, please. All right, just to wrap up the conversation around the budgets now. So on your slide, you see a couple of different budgets. So we have the operational budget, that really breaks down projected revenue, and that's really grant revenue coming in. Then we have capital budgets, and this is important because I know recently IRCC in particular started funding capital dollars. This may be in the form of computer, furniture, and so on. So you really want to likely do a capital budget separately. A program budget, and this is different from your operational budget because your program budget feeds into your operational budget. And let me just spill that out a little bit. The operational budget is the overall budget of the organization. So let's just say you have funding from IRCC, MCCSS, City of Toronto, or wherever jurisdiction you live in. All those different programs and MOUs and contribution agreement form the operational budget. Your program budget is different because it's very granular to that specific program. So for example, if IRCC has a budget separately for each different program, let's say gender-based violence or violence against women, your program budget is just a reflection of the budget for that program only. And this is important because you want to make sure that on each program, you are able to identify deliverables set out within each program contribution agreement. So again, the program budget of each program is the input for the operational budget. The grant proposal budget is generally that piece that comes before. So for example, when you start responding to a RFP in 2024, you're going to have to start writing proposal and grant budgets for each one of the proposals that you intend to submit for. So again, most of these feeds into the operational budget. I do know that some agencies have their capital budget as part of the operational budget because it's funded that way. But it is important, even if it's funded that way, that you have a breakout capital budget so that you would know exactly what your capital needs are. And those needs might include, for example, new computer equipment for new staff if you have a new program. And when we talk about long-term or multi-year, it simply means that computer that you bought or that chair or that desk or anything that's categorized as a capital expense last much more than just 1 year. And again, that's the meaning of multi-year here. So anything that generally lasts more than 1 year, we categorize it as capital and should be charged to those lines. And again, I do know that some contribution agreements may differ, but generally speaking, it would form a capital item. Next slide, please. So the components of a nonprofit and charitable budget would be revenues, your streams, your donations, and any self-generated income that you may have. And these might be, or it might include, let's say, a speaking fee. It might be any fundraisings that you would have done. Those are income that's outside of your grants, your contribution agreements, and your MOUs. And on the expense side, we have, of course, we have all the program expenses, for example, professional fees, direct program expenses, travel, client engagement, client travel, translation fees, and so on. And of course, we have that range of admin expenses. And generally, admin expenses are those fixed expenses that cannot change based on the program. So for example, as I mentioned earlier, rent, telephone, the finance manager's time, the HR manager's time, supplies, and again, those expenses that are spread out across the programs. And those expenses generally are where your pressure points are. Now, I have a note in there that salaries and benefits could be part of any of the above because I do know that some contribution agreements, the staff that are directly involved in the program, for example, the program coordinator, those salaries will be part of the program expenses. But the time of an individual who's shared across various programs, for example, your finance manager, that generally, or that component of time will or should be within your admin expense bucket. So again, it depends on the role, but generally speaking, anybody who has a direct role or direct involvement in the program should be program expense, and anybody who has an indirect role in the program should be within the admin expense category. And again, that's the general rule. Some agencies I know have negotiated differently, but again, as a general framework, that's what it should look like. Next slide, please. So again, just to bring the whole piece around budget together, some of your considerations that you should think about in January as you go into your budget exercise is defined activities. What would you like to accomplish? What does your contribution agreement say you should accomplish? And that's important because if you sign a contribution agreement that says, for example, that you should deliver 10 workshops and you can't deliver 10, but you could only deliver 7, that's an issue. That's a consideration that you have to justify, that you will have to adjust. Time period, as I mentioned just now, most budgets are done within a 12-month period, and that 12-month could be any 12-month of your agency's choosing. So when you decide to do your budget or in your budget preparation, you should consider the time period, because I do know that most funding agreements do not allow funds to be carried across fiscal years. And this is important because if you're running short of time, you run the risk of having to be defunded, having to give money back, that term that nobody likes, slippage. You want to stay away from the chance of any slippage at all. So it really is important, going back to that 2-month period that I spoke about early on, that you really pin down your time by various month buckets. We talked about deliverables in line with budgets a bit, so I wouldn't spend too much time on that anymore. I covered administrative pressure points earlier on. Again, that's all of the charges, all of the expenses that you really cannot control. And generally speaking, those are the ones that the funder tends to say, well, you have to find a way to figure it out. But as I mentioned just now, those expenses do not change, or often do not change, depending on the budgets you have or depending on the programs, right? So they tend to generally be fixed. Important consideration for those organizations that are part of a collective bargaining unit: contractual increases. If you have a budget or funding agreement that does not change or doesn't give you more money in the final year or the 3rd and 4th year of that agreement, but you have a contractual agreement that forces you to pay salaries 2 or 3% more, you have to be creative. So it really forces you to figure out how you're going to fund those increases within the same funding envelope that you have. So again, that's also another reason why you should start the conversation well in advance of the start of the fiscal year. And again, any contractual agreements that you have that's external, as I mentioned just now, you might be on a fixed contribution agreement from IRCC, but your rent might increase in years 4 and 5 of your rent agreement. So you really have to start pulling those agreements in January, have them all lined up on your desk, and try to quantify all of the changes, because those are the key inputs that will determine if you have enough dollars, if you're going to have to cut something back, if you can meet your objectives, or if you have to go back for more funding. So again, these are some of the key considerations that you need to have at the top of your fingertips, right in front of you at the start of your budget exercise. Next slide, please. Okay, so I have in front of you a budget template that I have developed. Now, no need to stress yourself about what it looks like. There is a full tool and resource available, and Adele did speak to it. So I'm just going to speak to this really high level. I have developed a full template for you, and you can download that from this site when you're through. Again, you can change this based on your own agency's needs, but again, what does a budget look like? Again, it really identifies all your inflows. And what I've done is identify each inflow by funder. So again, everything at the federal level, everything at the provincial level, everything at the municipal level, and everything that's other, whether it's your own dollars, fundraising, and so on. So this is what your budget should look like. And what I've done with this template as well is shown you why a comparison is important, because it will help determine or decide your pressure points and also trends, right? if you want to look at the outflows as well, what I've done is identify each cost area. So all of the staffing costs, salaries, benefits, training, all of the generic training costs, so program travel, program supplies, program development, translation, and so on. And I've listed out the admin category in a little bit more detail because I do know that IRCC tend to ask for these details. So if you're funded by IRCC, again, the recommendation is that you would itemize these as much as you can. I know it could be a challenge at times, but if you have a internal software, for example, QuickBooks or one of those online tools, it really allows you to break this out as much as you can. Now, you do notice that I do have a couple of rows in red in the extreme right columns. That's because what I wanted to show you here is reallocations, right? If you have a reallocation or you request a reallocation, make sure you have the notations to support it, because I can assure you that your auditor would ask for it. And as part of your financial monitor as well, they may ask you, well, what triggered this change? Because as you know, you may have a change of rep or change of accounting officer by the time you get to a financial monitor. So the whole point of highlighting this in red is because there is a change, because there's a reallocation, you want to keep the documents or the source documents or everything that has an email thread with you so it supports that file. Keep it in your file. If you have a physical file, put it in there. If you have an electronic file, drag those emails in there because you really want to keep a trace of those supporting documents and so on within your program file. Next slide, please. Again, this is the outflows. So we talked a little bit about the staffing costs, and I have broken down these in as much detail as I can because you want to really have this data for meaningful comparisons. So for example, you might have staff on salaries that may not get benefits because they are part-timers, or they might be on a contract. And when you break it out, you might be able to make a meaningful reallocation between benefits and salaries if you have surplus in salary dollars. So again, the purpose of really itemizing it and being as granular as you can is to drive those reallocation and changes that you know might come later on. I know you might be tempted to put it all together, but when you lump it all together, it really takes away from the evidence you need to justify some of the changes that you might have later on. So again, I've tried to be as granular and as detailed as possible. I know some of these line items may change, but most of these line items have been taken from an existing IRCC contract. But if yours differ, you're more than free to use the tool that I've provided to make whatever changes that you need within the realms of your own organization. Again, this document shows any surplus or deficits that you have. If there are any board members on the meeting today, and I do believe they are, in the nonprofit world, in a charitable sector, you really should not be approving a budget that has a deficit unless you have reserves to fund operational deficits. And again, that's often challenging because what it tells you is that you are not paying attention to service level versus costs. So from a governance framework, that is a red flag. So again, I would encourage any board member through the FAC or through the approval process that you make sure, or that I would recommend, sorry, that you approve annual budgets that are zero. Now, let's flip the coin a bit. You might ask, well, should I approve a budget as a board member that has a surplus? Well, I would say no, unless, and this is a very big unless that line item that says fundraising or other income has those equivalent dollars in it. And the reason for that is because when you get funding from a funder, the intention is that all of those dollars should be spent. So if you have surplus dollars from a funder or in your operational budget and you don't have alternative source of self-generated income, it tells the funder that you did not need all those dollars. One, you're not meeting all the program objectives, you did not budget properly, and maybe we can claw some of these dollars back in the future year. So again, just to reiterate, the only way you should approve a budget with a surplus is if you have self-generated income that quantifies the surplus dollars that you have. Because all program dollars or all contribution agreement or MOU dollars should be fully spent at the end of the fiscal year. We talked briefly about slippage and reallocation. If by January your year ends in March, you're realizing that you have a little bit of surplus dollars, that's the time when you should be asking for a reallocation of dollars. That's also the time when you should be reaching out to your contribution agreement officer and say, hey, you know what, can I move those dollars to a different line item? Don't wait until March because you're going to run into significant challenges. But again, just to wrap this piece up, a board should not be approving budgets with either surpluses or deficits, because what it does, it really defers the problem into the future, and the future could bring its own set of challenges. So you really want to stick with approving a zero budget. That is a budget with a zero surplus or zero deficit line. Next, please. Right, I know time is moving quickly, so I'm going to try to pick up this pace a little bit. This is really 12:48 and we have about a half an hour left. So we're going to talk a little bit briefly about financial reporting fundamentals. What is financial accounting versus managerial accounting? I'm just going to touch on this quite briefly. There is a difference, an absolute difference between the two. Financial accounting is driven by statutes, or what we call generally accepted accounting principles. It's regulated, it's often required by law. Whereas managerial accounting, on the other hand, are internal reports that we need as organizations to make decisions internally. So for example, your accounting statements that are part of your financial statements year-end audit are what we call financial accounting. Your budget documents, your write-ups, your forecast are decision-making tools that inform managerial accounting. It's different because there is no set standards or templates or formats for managerial accounting. You could design your budget in any template that you want. I have provided you with a tool, but you're more than happy to change that tool as you see fit. You're more than happy to change that tool to align with your agency. Unfortunately, you don't have the luxury in changing the format of financial statements because it's driven by standards. And that's the generic or the overview of the difference between financial and managerial accounting. Next slide, please. Unfortunately, as charitable agencies and as nonprofits, we are not exempted from having to prepare financial statements. As you know, almost all funders do require a full set of financial statements at the end of each year. If you've never been funded before, IRC, so even the province, will ask you for up to 3, up to 4 years previous financial statements. So it really is important that we have these. And these statements generally need to be audited as well. And we're going to speak to that a little bit later. But unfortunately, even as very small agencies, we still have to comply with the regulations. So I'm going to speak briefly about the different financial statements. So what we know as the balance sheet, everybody knows it as the balance sheet. It's the common term, it's the layman's term. In the accounting term, it's really what we call a statement of financial position. It depicts the financial condition of your agency at a specific point in time. And this is important because it does not capture data for an entire year. The statement of financial position in particular is one that shows the overall position of the agency at one specific date. And that date usually is, in our case, December 31st, if your year end is the same as your fiscal year, or March 31st. So generally speaking, those two, your fiscal year may differ, but it generally shows the position at the end of your fiscal year. The statement of operations, we know that generally as your profit and loss. In the nonprofit sector, we tend to stay away from that terminology because we don't make a profit and we certainly don't want to make a loss. we choose the language of surplus versus deficit. It represents really the difference between what you get from grants, what you get from all your program dollars, contribution agreements, any self-generated income versus any program expenses. And we talked about those program expenses before, salaries, benefits, and so on. So when you put those two together, your statement of operations really calibrates the difference between all your revenues versus all your expenses. At the end of the day, this statement will show whether the agency had a surplus or deficit. And as I mentioned just now, if you have a budget of 0 at the bottom, your statement of operations should be very similar to that budget as well. Next slide, please. Then we have the other two, which is your statement of cash flows. This is pretty important because it shows from an accounting financial point of view the movement of cash dollars within your agencies. And I'm going to spend a minute or two on this one because you might ask yourself, well, as a nonprofit, as a charity, why do I need to be concerned about cash flow? Well, some of you may not get cash advances from your funder. If you're lucky enough to have your officer approve an advance for you, then you will have dollars in your bank and you should be okay. But if you're relying on a system where you have to make the claim and then you get paid, then you might quickly realize that you are running out of cash before you get that next chunk of payment from your funder. So a statement of cash flow is important because it tells the auditor, do you need to do better at managing those inflows versus outflows? Should you be asking your funder for an advance? And those questions are generally driven or determined from your statement of cash flow. And the last one is your statement of changes in net assets. And to break this down in layman's term, it really shows any movement in your balances of reserves within that period or your accounting period of 1 year that we spoke about. So for example, if you had a budget of $1 million, but out of that $1 million, $20,000 you earned as your own agency, then you might have a deficit of $20,000 because you've earned that money through non-granting revenue source. And now you can choose as an agency to do whatever it wants with that $20,000. That $20,000 you may choose, your board may choose to put it into reserves. Your statement of changes in net assets will highlight that change. So that's really what it shows. Next slide, please. Now, coming out of the budgeting and the financial reporting pieces that we just spoke about, Ontario charities and nonprofits do operate within a framework, and that framework, unfortunately, does not change by the size of the organization. So most of you are part of agencies that are under $1 million in overall budget. Unfortunately, you still have to comply with the Ontario Non-Profit Corporations Act, and you still have to comply with the accounting standards for nonprofit organization in Canada, which is part 3 of the Certified Professional Accountants Canada Handbook. And of course, as you know, all registered charities have to comply with CRA requirements, and these requirements could include keeping a track of charitable donations, definitely keeping a track of charitable receipts. You have to file your annual return, which includes a review of your board directors and so on. I'm not going to go into this statement, but that's the generic framework on which all of us operate. And my point with putting this slide in is really to highlight to us that even though your agency may be small, you don't get to be exempted from the framework, or you don't get to be exempted from the standards. The standards apply regardless of the size of your agency. And it really is important from a governance framework that board, in particular, and the ED and the staff, pay attention to the standards and also ONCAD that got passed very late last year. So again, this slide has been put in here to help you understand the framework that we operate in as an agency, as a nonprofit. Next slide, please. Now, this slide is important because we tend to use the language of nonprofit interchangeably with registered charities. Unfortunately, that's not quite correct. Once you become a charity, you're no longer a nonprofit. And I have to repeat that because a lot of us use the language interchangeably. Once you become a charity, you're no longer a nonprofit. You might operate in a nonprofit space because you're not making a profit, but they are two distinct terms from a tax implication. And the biggest one is that charities can issue a donation tax receipt, whereas nonprofits absolutely cannot. Once you have started as a charity, as a nonprofit, you can morph into a charity. But generally speaking, most agencies start off as a nonprofit and then they morph into a charity. But again, I want to reiterate that once you become a charity, you're no longer a nonprofit. I know you tend to see yourself as a nonprofit because you don't make a profit, you serve the community as well, but charities have a different level of different implications that they have to abide by. And most importantly is point 3, and I'm going to show you an example in a few minutes. Charities get a refund of the provincial federal taxes of 82% of the 8% and 50% of the federal portion, which is 13%. As you know, we do pay 13% HST in Ontario, so 8 plus 5, but only a registered charity get those rebates. So if you're a nonprofit and you do not get charitable status, point 3 does not apply to you. So I would recommend to anybody who's on the line, if you are a nonprofit, but you don't have charitable status, take the time, make the effort to apply for it because it is definitely worth it, simply because of those refunds. It also allows you to expand your wings in terms of getting donations because you can exchange a donation tax receipt for those donations that a nonprofit cannot do. Next slide, please. Okay, this is important because I did get feedback from you, from some of us helping to explain this particular point, and this is driven through an example. Okay, so let's just pretend for a minute you hire a contractor for $1,000 to do translation of one of your programs. As an agency, you would write a check for that contractor of $1,130. We're assuming that the contractor is HST registered, so you will pay them that $1,130. I think that should be an easy example. However, as a registered charity, unfortunately, you cannot bill your funder for 1130, even if that's the amount you've paid out to that contractor. And I want to stress that even if you've paid out 1130, you cannot bill your funder 1130 because of point 3 in the previous slide. And I've pulled out an excerpt from a current contribution agreement that says only the portion of the provincial and federal tax GST HST, which is non-refundable by the CRA as an input tax credit or as a rebate, can be claimed as an eligible cost. And I've put Oprah there because I know a lot of people get confused when I say this, but I swear it's not as bad as you think it is. So let's go to the next slide and I will help you understand it through an example. So in the slide before, I did say that you hire a consultant and he's charging you $1,000 plus HST, which is $1,130. So you're going to write a check for Roger Ramkissoon for $1,130 because I've invoiced you that and I've billed you that. However, you as an agency are going to get back $65 from the provincial government because you're a charity. You're going to get back $25 from your federal government because you're a charity. So you're going to get back $90 from two government sources. So $90.60 is what you're going to get back from your funding source. Now remember, the HST that you would have paid to me is $130. You're going to get back $90.60. It means that when you write your claim or when you submit your claim, you could only claim the difference that you're not getting back. And that aligns with the slide before that point that I pulled out from a contribution agreement. And that net HST expense is $39.40. So you have written a check for $11.30. You're going to charge the funder $1,039.40. And you're going to get back $90.60 through the rebates. So that's how you reconcile. That's how you're going to even out the amount that you've paid to me. But here's the problem. You could only get that $90.60 back when you filed your charitable or HST rebate. So as a charitable organization or as a nonprofit, you have to make sure that you have that $90.60 in your bank account from some other source to be able to make sure that that check that you've written to me does not bounce. Because remember, you're only going to get $1,039 back from your funder. You're going to get $90 later on, but you've written a check to me of $1,130 already. So when we talked earlier on about cash flow management and the statement of cash flows, that's part of the challenge as to why you need to have a budget and why you need to have cash flow. Now, this is an example of a simple transaction of $1,000. Just imagine if you were paying out contractors $100,000, $200,000. This number will definitely increase. So it helps you to understand why cash flow management is important, which ties back to that statement that we talked about just now, which is the statement of cash flow. Now, I know this number slide might have been a little bit complicated, but I hope that through the example and through breaking it down as simple as I can here, that you understand the different nuances. The two nuances to take away is that you cannot bill your funder for $11.30 and that you must have that $90.60 in your bank account somewhere, whether it's through a line of credit, whether it's through an advance, you must have it somewhere to be able to make sure that check does not bounce, because you will only get it back at the end of your filing. And most agencies file twice a year, half year at the end of the half year period point and at the end of the fiscal year after an audit. So again, depending on the size of your agency, you have to have all those $90 in your bank account. And again, take a minute, write notes down. I'll be more than happy to address any of these in questions next week because I doubt we'll have the time today. Next slide, please. Okay, we're going to move quickly into financial oversight and controls. What does that mean? And as a governance professional myself, I'm very rules-based. As I mentioned at the top of the slide, I'm a chartered professional accountant. I'm also a CHRL, so I'm really rules-based driven. But I've also learned that it's lack of those rules that gets us in trouble, right? So we're going to talk a little bit about policies, procedures, and processes, and how they are a means by which an organization monitors and controls the direction, allocation of all those dollars that we just spoke about. And we're talking about financial resources here. These controls are designed to prevent and detect fraud, misuse of funds, and also misuse of resources altogether. They are very essential in achieving financial responsibility, managing risk, maintaining stability, and achieving operational program efficiency. And let me give you an example. For example, let's just pretend you have $1,000 in petty cash at your agency. That's your petty cash rules. You have $1,000. Do you know how easy it is to lose petty cash or how easy it is to misuse petty cash dollars without having proper controls and procedures in place. It's really easy as well to misappropriate payroll dollars. For example, Roger might be doing work on a violence against women project, but he's being paid by gender-based violence. That could be seen as a misuse of payroll dollars. So it is really critical that at the genesis of any financial oversight and controls conversation, that as an agency, you have policies and procedures and processes in place. I have designed a few tools for you to substitute some policies. Again, these templates are designed to help you have a framework. You are more than happy to use them, change, edit, amend them to your agency's needs. But I do believe that what I've provided to you provides a really important framework for you as small agencies to help you on the road of proper financial oversight and controls. But again, in our space, one of the things that auditors always look for is your T4 summaries, because it has been proven time and time and again that payroll is one of the areas where it's easy to misappropriate funding dollars. That is why when you have a financial monitor, your monitoring officer would ask you for payroll stubs. Again, it's all aligned to this control point. Next slide, please. Now, there is a difference between a process versus a policy versus a procedure. Generally speaking, and I'll start with the middle first because that's the one that the board should be concerned about. As a board, you should be asking your AD the very tough question. Do you have a financial policy? Do you have a payroll policy? Do you have a purchasing policy? Do you have a sick leave policy? And so on. You should have those policies in place. Now, you might have a broad HR policy that speaks to those things. You might have a broad finance policy that speaks to purchasing limits and so on, but it needs to be in some document that you call a policy. And as I mentioned just now, I have provided a couple of templates for signing authority policy, purchasing policy, and so on. So you, by all means, you are free to use those templates and tweak them accordingly. The procedure complements the policy, and that's the detailed document as to what you shouldn't do. It provides detailed instructions of how to do tasks, and the process outlines those tasks. So for example, if you have a check requisition process or policy, your step one should be finance manager receives a check requisition, issues a check, sends it to the ED for signing, passes it back to the program files a check, program mails it out. That might be an example of a process. The process generally is a living document because that process might change. We've just come out of a world of COVID and you may not be working in the office, so you might have to do things from an online space. So you might want to make sure that your process gets reviewed very often. Your board should essentially be the one who approves policies through the various committees. And you would notice in all of the policies that I've designed for you, at the end, at the very last page, you will see that I have a timeline for review of each one. This is extremely important because things change, statutes change, legislation changes, and you want to absolutely make sure that your policies are managing those changes, that your policies keep current to new legislation that are in place. For example, we had ONCA coming on board last year. You want to make sure that all your policies are aligned with any legislative changes, right? So again, there is a difference. The board generally approves the policies. The procedures are generally approved by management internally. And the process generally, I would say, is written by staff and approved internally as well. These three documents could be part of one whole document, a policy document, but the process versus the procedure and the policy should be identified, because you want to make sure you trigger the responsibility layers, because the staff might be in charge of the process, the manager might be in charge of the procedure, and the board will of course be in charge of approval and changes of that policy. So again, you could have a one document, you could have a catch-all document, but it should outline the various pieces. And as I mentioned, each one of the policy templates that are done for you do tell you when changes or when a review should be done. Next slide, please. So talking a little bit about controls now. We talked about policy and separation of duties just now. You absolutely should have them for key risk management areas, payroll, signing authority, and so on. Now, I know that most of you are small agencies, if not all, and you may not always have the staff to do payroll separately, payable separately, grant reporting separately. You might have one person doing it all. So you may not have the resources to have effective separation of duties. However, within that framework, your policies and procedures should cover the different functions within the role. For example, if you have one person doing it all, then your policy should state, well, if the finance manager issues the check, he should not sign it. Or a board should sign it, because the board is an independent, non-paid employee of the organization. So it is possible to have some level of separation of duties, even though you do not have the resources to have a staff member for each area of the process. Something else that's really, really important is monthly bank reconciliations. This is really important because that's the point where you tend to catch things that could trigger fraud. For example, it's in your monthly bank reconciliation, you can tell if, for example, your finance manager or your clerk would have issued a check that should not have been issued. If you let your bank reconciliation sit for 6 months, it will take you 6 months to identify that a check was improperly paid and authorized. So it really is important that you do these reconciliations every single month. I know, generally speaking, most banks have their statements ready by the 5th of the next month. So the general rule is by the 10th to the 15th of the following month, your bank reconciliations should be completed and signed off. So if you have the statement cutting off by the 2nd, 3rd, the statement is available by the 5th. Within the next 10 days, it should be done, because it gives you a smaller window to identify anything that has gone wrong in the previous month. The next thing that you want to pay attention to is authorization forms. We all have program people managing our budgets, but you want to make sure that every line item that you spend $1 on, it's authorized, because you don't want anybody spending program monies without authorization to do so. I've developed a tool for you to do exactly that. For every expense outside of salary and benefits, of course, we know those are fixed. For example, if you have to pay a trainer, you have to reimburse somebody for transport, have an authorization form to ensure that there is a proper trace and trail and approval for those expenses, because you don't get to say in 6 months' time, I didn't know, right? So having the form is one thing, but having the authorization is important as well. The form should be driven by the program coordinator. There should also be somebody outside of the program who's authorizing those expenses. So for example, the finance manager, who will be very much in tune, or who should be in tune with the overall budget and those line items, right? So if you don't have a finance manager and your AD is the one who's doing the budgeting and so on, get your AD to sign it. Petty cash limits. And again, as I mentioned just now, it's one of those areas where it's easy for cash to be lost. Have a proper form, have proper authorization process, ensure that you reconcile and tally your petty cash every month, every week if you have more, And again, because if you miss $2 today and you let it slip, you might miss $20 tomorrow and let it slip. And again, you want to make sure that you identifying and closing any potential gaps for misuse of funds. And I'm going to take a breath by credit card monitoring because this is the easiest one of them all to go haywire or to go crazy or to have misuse of funds. You can lose a credit card. You can get it in the hands of the wrong person. You can get it in the hands of somebody who's not authorized to use it. These days, all you have to do is tap and go. And I don't have to tell you how difficult it is to get a bank to prove, or for you to prove to a bank that you did not make that purchase. So if you have a credit card, sign up for instant notification. So if somebody happens to use a credit card fraudulently, you would know automatically. Have a signing authority, and I have designed a signing authority policy for you. It's there, you can use it. Make sure you have payroll timesheet controls in place as well. One person should never be inputting timesheets and approving payroll at the same time. If your AD is doing the finance function, make sure it goes to AD for final approval. Next slide, please. So common policies in our sector, purchase limits. So for example, one person should not be approving a purchase more than a number that you may choose. It might be $500, $1,000, $2,500. And this applies to the executive director as well. So your AD should have a limit as well, which should go to a board of directors. I sit on a board and Sudeep is here today. Anything over a certain amount comes to the AD, just comes to the board to sign. So again, there are things that you can do to help with the control. Signing authority. So for example, checks over 500 must come to a board member. You must have two to sign and so on. You should never have one person signing checks as part of your signing authority policy for obvious reasons, because then it really breaks down the control and it increases the opportunity for misuse of funds. Approval authority, that could tie into signing authority. That's also well outlined in the template that I have developed for you. Make sure you create requisition forms that have a process for anybody who should be signing those forms. And again, it should be triggered from the person who's managing the budget or the program, but it definitely should feed through the person who's managing the overall budget of the agency and so on. Make sure you have a responsibility for financial record keeping. You can also have a reserve surplus policy, and that will identify what you do with extra dollars. And by all means, you should have a risk management framework in place. Next slide, please.
Sorry, Roger. Just want to pause you. We still have 10 minutes, and I was wondering if you can continue for 5 minutes, but then we pause and we can continue the rest of those slides in the next session next week. Would that be okay?
Yeah. Can you just tell me how many more slides we have? I think we have about 4 more.
One moment. I can see it from my side. One.
Yep.
9 slides.
Okay, so we probably would wrap up with external auditing, and by all means, we can continue the other pieces next week. And I know this is a lot of content, so I'm trying to go as slow as possible so that folks can really understand the takeaways and you can really benefit from it. So what really is an external audit? Unfortunately, as I mentioned just now, regardless of the agency you're in, once you incorporate it as a nonprofit or charity, you will be succumb to an external audit. You will have to do it. It is an in-depth examination of the financial records of the agency. There is a misconception that the auditors prepare financial statements. The auditors doesn't. The agency has to prepare those statements. The auditor checks or examines those statements. The auditor does not come in and prepare statements for them to audit, right? They take your preparation and audits your preparation. One of the other things that the auditor does as well is to examine internal controls. And we've all probably familiar with this term called a management letter. That's where the opinion on those internal controls come in. The main goal of an assurance audit or any kind of audit is to just to make sure that agency is doing what they should, and of course, to offer an opinion on the organization's financial health and to ensure that it's somewhat free from material misstatement. And this is important because it is possible that the auditor may not pick up an issue of misuse of funds. For example, if somebody uses $20 to buy TTC tokens for a program, but takes those tokens for themselves without accounting for it, the auditor will not pick that up. So the auditor will not identify every opportunity or every avenue for misuse of funds, but certainly they will identify ones that will come to light. So it's not the auditor's responsibility to issue statements. The auditor does a verification process. Next slide, please. And again, elements of external auditing generally done by an independent accountant. You cannot have auditing done internally for statements. It has to be done outside. The auditor is there to offer an unbiased opinion. It's generally conducted annually. The arm's length of the agency, and that means that they have no internal relationship with the agency. The external audit focus is really about evaluating the statements that was prepared by the staff. Again, I have to reiterate because there is a general misconception that the auditors prepare statements. They do not. A role of the auditor as well is to identify control gaps and of course to recommend to the board through a committee. Now, just to add, the auditors generally should report to the board of directors, not the ED. That's why I said in slide 2, have a finance and audit committee. A lot of us thinks that the auditors should communicate directly with the ED. They should communicate directly with the treasurer of the board or a board committee. And that should be the line of communication because you want to make sure that there is no filter of the information between the staff and the auditor. That's why the auditors generally report to boards through a committee. Next slide, please. All right, so we're probably going to wrap up here. It's exactly 1:25. I think we got to cover contribution agreements, and I think that should be the last piece on sustainability next week, Thursday. Adele, I will turn it back to you.
Thank you, Roger. Can we please go to slide 37? Okay, Roger, any last comments?
This is a little bit about me. I would encourage you to channel your questions to Adele. I will be back next week, Thursday, where I would take your questions. I know some of you might have agency-specific questions. If you have those as well, feel free to email me or through Adele, and I will be more than happy to assist you where I can. But what I would encourage you to do is to get your questions together, share it with Adele ahead of time so that I can have some time to review those questions, and I will be more than happy to address them next week, Thursday. So with that in mind, before I turn it back to Adele, I want to really thank you for your participation. I want to thank you for your attendance, your commitment to learning. I know finance and accounting is a challenge. As program managers, we tend to say, okay, leave it to the finance guy. We should have a good overview of finance and accounting. That's why you're here today, because of your commitment to want to learn. And I really am proud that we're moving in the right direction. So again, thank you so much for participating, for attending today. I really look forward to addressing your questions in the next session. Adele, back to you. Thank you again.
Thank you, Roger. Please, can we go to 39? Perfect. Well, first, I would like to say thank you, Roger, so much for this brilliant presentation. If I want to speak about myself, I would say I've learned a lot in this presentation. I have my own list of questions now regarding the finance management. So please, everyone, next week we have our follow-up question and answer session. And just to echo on what Roger have already stated, please feel free to send us your questions. It can be on Slido. I noticed there's a few questions there already. You can also share your questions with me by email, and we'll be addressing them in the next session next week. It is December 14th from 12 to 1. It's going to be a 1-hour follow-up session. Yes, next slide, please. One more thing to add, we have launched a new workshop outside the series that will be focusing on the proposal writing part 2, walking through the IRCC CFP application. The first session will be December 21. If you have not yet registered to that specific workshop, please let us know. We'll send you the invitation. And then after 2 weeks from that session, there will be a follow-up question and answer on January 4 from 12 to 1:30 to also address your questions. Next slide. Thank you, everyone. Thank you to our speaker, to Roger. Thank you to our interpreters. And thank you for the OCASI staff who are here to us today to support. And thank you, everyone, for being part of this workshop series. And have a good day.